Welcome back to our intermediate financial accounting class. In our last few segments, we've been talking about taxes. We've talked about normal tax calculations, where taxes go in our financial statements, how we record deferred taxes, all of the steps involved in coming up with a real income tax expense journal entry. Not the simple ones we've done in the past, but all of the pieces of a real income tax expense entry. In our last segment, we then went the next step forward. What happens if we've got a loss instead of a gain? And we calculated NOLs and what do we do with them and how do we do a carry back and a carry forward. And now it's time to take a look at how we use an NOL carry forward. And then at one other last issue with NOLs, what happens if we think we're going to lose a carry forward? So let's jump right into it by going back to our example of Zoop. So if you remember from our last segment, Zoop had a $600,000 NOL, and they used up most of it. They used $350,000 of that $600,000 NOL to do a carryback and cover year 2 and year 3 taxable income. As we come into year 5, I still have an NOL carry forward of $250,000, and because the tax rate in year 5 is 30%, I think it's a good idea to use some of that $250,000 to cover this $100,000 of profit. Now, the key to using a carry forward is to use the NOL to cover the taxable income. You don't try to use the deferred tax asset that's already adjusted for taxes based on year 4's percentage to cover this year's taxes based on this year's percentage. You don't do it that way. You use the NOL to cover the profit. So just like we did before, I'm going to look at my remaining NOL, which was $250,000. Now I'm going to take this $250,000 and I'm going to use it to shield $100,000 worth of income in year 5. So my year 5 taxable income is $100,000, which would leave me with a remaining NOL still of $150,000 that I can use in the future. Once I've shielded that amount, then I can take the $100,000 times this year's tax rate, since that's what I would be paying, and I'm going to save $30,000 that I don't have to pay taxes on. So the way I do this is I record income tax expense on the $100,000 of $30,000, and instead of income tax payable, I use some of my deferred tax asset. And then my tax department would fill out the forms, and instead of sending a check for $30,000, I simply don't pay anything. To record use of net operating loss. Hopefully that makes sense. It's a pretty straightforward calculation, but please don't stop here. The last thing you need to look at is your T account, because we need to make sure that we're keeping track of what's in that deferred tax asset account. So we started last time with $62,500. Now I've used up $30,000. So I still have a deferred tax asset of $32,500. Now I estimated this deferred tax asset at 25%. If I'm able to shield at tax rates higher than the 25%, eventually I'm going to get an extra bit of a gain from this deferred tax asset. We showed a benefit due to loss carry forward. We'd have an additional benefit due to loss carry forward as we used this deferred tax asset to cover more than just the $32,500 that's remaining. But every year that I decide to use up some of that NOL, I would do a journal entry very similar to this until I run out, or until for some reason I figure out that I'm not going to be able to use that NOL anymore. And that's the last thing we need to talk about with NOLs. If for whatever reason we think an NOL will not be used, which seems really crazy, but there's a possibility of that right now. One of the presidential candidates is recommending a flat tax. So we'd move from a 40% rate to about a 17.5% rate, I think he's recommending. So that would drop our obligations. And because of those obligations, well, we might not get to use our NOL anymore because the tax rate has fallen, or because he simply wiped all of it out and said that all of us need to pay 17.5%. So for various reasons, an NOL may become unusable, or at least less usable than we thought it was going to be. When that happens, we don't write down the deferred tax asset account. What we do instead is we create an allowance. And the reason we use an allowance account is because taxes are so volatile that I might think here in 2016 that I'm not going to get to use all of my NOL from 2006, back from the example we were using in our last segment. But in 2017, 18, or 19, tax rates may change, the tax laws may change, and all of a sudden, oh yeah, I guess I can use this NOL. So because of that, instead of writing down to the deferred tax asset, which I can't write back up, that's GAAP, FASB says put it in this allowance. And they've given it a very long name. It's called the Allowance to Reduce Deferred Tax Assets to Expected Realizable Value. Crazy, isn't it? If we put it into the allowance and later on we realize, oh, I can use it, I can wipe out the allowance and it's fine. If I drop the actual deferred tax asset account, it's down. I can never write it back up. So we use an allowance instead. Luckily, the process is relatively straightforward. Let's take a look at an example that will help us illustrate it. In year 6, they've started a price war with a competitor. It looks like they'll be able to keep their doors open, but they're not going to report any taxable income. So they'll be able to meet payroll, etc., and that's it. Because of the price war and these really low profits, we're not going to be able to recognize any NOL. Now, this is really sad if you think about it, because we're 2 years into a 20-year period, and they don't think they're going to get to use the NOL over the next 18 years. How they're going to stay in business for 18 years with no profit, I don't know, but just go with it for the sake of this example. We want to make the necessary journal entry to record this drop that we won't get to use our NOL. So as always, I like to break things down into steps. So step number 1, we're going to estimate our future profits. This is all of our profits until the end of the 20-year carry forward period. And we're going to multiply that by the estimated tax rate. And that's going to give us a new value of our deferred tax asset. In this case, we think our estimated future profits are going to be 0. Tax rate has been about 30%, but 0 times 30% is still 0. That's step 1. Step 2 is to determine the allowance balance. That gives us this new value. So let's take a look at our T account. Our deferred tax asset was $62,500. We used up $30,000 of it in year 4. So our balance is $32,500. We think it's worth 0. So I need an allowance that will allow me to get to 0. So this is an allowance to reduce our deferred tax asset. And my desired ending balance, what I want is this account plus that account to equal this number, so 0. So if I've got a debit of 32.5 here, I need a credit of 32.5 there. Starts at a 0. So if I want to go from 0 to 32.5, I need a journal entry of 32,500, which leads me to step number 3. The best part, gets me my journal entry. So I'm going to debit income tax expense. We don't record a loss. We put it right to this year's income tax expense. I'm going to credit my allowance to reduce deferred tax assets. This is record, drop in estimated value of NOL from year 4. Now, this is a really extreme case where we think is worth absolutely nothing. Let's look at one that's perhaps a little more realistic. So let's assume that instead of dropping to nothing because of a price war, what happens if instead The change is because our marginal tax rate has dropped from the 25% we thought it would be in year 4 when we created the NOL carry forward and the deferred tax asset that went with it to 15%. So my marginal tax rate has just changed. Take my estimated future profits that I think I can cover with the NOL times the tax rate, and that's going to give me my new value of my deferred tax asset. I think I can still use all of my NOL. So I'm going to use the full 150,000. That's what's left of the 600,000 of the original year 4 net operating loss. Tax rate is 15%. So the new value is 22,500. That's what I think it's worth. Step number 2 is to determine the allowance balance. And to do that, I look at my deferred tax asset account. Again, it started at 62,500. I used 30. This example assumes that the one we just did where I wrote it to 0 didn't happen. So we're at 32,500. So I need an allowance balance that gets me to this 22,500 value from up here. So let's see, to get from 32.5 to 22.5, I need a credit of 10,000. And that's my journal entry. So I have income tax expense, and my allowance to reduce deferred tax asset, 10,000. Drop in value of year 4, carry forward. Now, if I move into year 7 and I realize my tax rate goes up to 70%, I would redo this calculation. I get a new value in my allowance, and I could do a new journal entry. Fun stuff, isn't it? All sorts of things that are involved in calculating and estimating NOLs. Again, the big idea with this allowance account is so that I can write it up or down, as opposed to just writing down the deferred tax asset and then under general GAAP rules, I could never write it back up again. So that's what I'm trying to avoid with the allowance. Now, we've talked about a lot of stuff with taxes. We've talked about how we calculate our income tax expense, how we calculate our deferred taxes. We've talked about NOLs. We've talked about temporary and permanent differences and how it all fits. The one last thing we need to talk about just briefly is how it fits into the financial statements and what FASB requires that we report in our financials. Now, we've talked about how much it impacts the financials already. All we're doing here is adding the specific FASB regulations for what must appear. So the first is what has to show up in the balance sheet, and that is that companies usually show just one value for their deferred taxes on the balance sheet. They don't have a deferred tax asset number and a deferred tax liability number. They just have the one value. Now, it used to be that we had to break them down into current and long term, and you might still see that with some companies because the transition period for phasing out current versus long-term deferred taxes hasn't ended yet at the time that I'm making this video. The rule there was if the cause of the deferred tax was short-term, you called it a current deferred tax. If the cause was long-term, you called it a long-term deferred tax. The process was all the same, we just separated them out. So in these older financial statements, you'll see two values, a current deferred tax asset or liability and a long-term deferred tax asset or liability. But FASB just recently, at the end of 2015, got rid of that requirement, and now companies are simply showing one value for deferred taxes, which matches us up with IFRS and makes it a little bit nicer and easier for us as we do our calculations when we have multiple adjustments that need to be made. The only other requirement then on the financial statements is that FASB requires companies to disclose the current taxes, so the taxes payable amount, the deferred taxes, and then an estimated income tax expense. So you're really having to show in the financial statements every amount from that journal entry. You don't have to put them in the financial statement. You can refer it down to the footnotes if you like, but it does have to be in the notes or in the income statement itself. Now, we've talked about a lot of information about deferred taxes. It's time to pull it all together in one comprehensive example. That's where we're headed next. We'll see you then.